In the wake of the pandemic, a financial specter has arisen, casting its shadow across the US, the specter of inflation. Inflation, a term that may seem elusive to many, is a broad increase in prices across an economy. It's a phenomenon that silently chips away at the purchasing power of your hard-earned dollar. In simple terms, it's why a cup of coffee that cost 50 cents in the 70s now sets you back a few dollars. In the aftermath of the global health crisis, the United States has been grappling with an unexpected surge in inflation. But what's behind this rise? Is it a temporary blip or a sign of more persistent economic woes? Leading economists Ben Bernanke and Olivier Blanchard offer some insights. According to their research, the inflationary surge wasn't primarily driven by labor market pressures as many had predicted. Instead, it was factors that directly raised prices. Think global commodity price increases and disruptions in supply chains that played a more significant role. Let's break that down. Global commodity price increases essentially mean that the raw materials used to produce goods became more expensive. So, whether it's the grain for your bread or the metal in your car, if the cost of these commodities goes up, so does the price of the end product. Supply chain disruptions, on the other hand, are a direct consequence of the pandemic. With factories shutting down and international trade routes disrupted, the flow of goods from producers to consumers was severely affected. This led to a classic case of demand outstripping supply, causing prices to rise. Fiscal policy, or government spending, also played a part. As the government pumped money into the economy to stimulate recovery, consumer demand for goods increased. However, with supply chains still in disarray, this heightened demand simply led to higher prices. As prices soared, the average American felt the pinch, fueling concerns of a full-blown economic crisis. While households grappled with soaring prices, a heated debate ensued among the world's top economic minds. The rising inflation was a cause for concern, but not everyone was viewing it through the same lens. On one side of the debate were the CEOs of multinational companies who were feeling the pinch of inflation in their respective sectors. They were witnessing firsthand the effects of supply chain disruptions and commodity price increases. These sector-specific woes were causing alarm bells to ring, and the worry was palpable in boardrooms across the globe. On the other side of the debate stood the central bankers, the guardians of our broader economy. They were not as quick to sound the alarm. They were looking at the big picture, considering the ebb and flow of the entire economy rather than focusing on individual sectors. Their approach was cautious, wary of tightening policy prematurely and triggering unwanted economic consequences. The central banker's stance was clear. Let inflation temporarily exceed targets to avoid knee-jerk reactions that could potentially destabilize the economy. They were keeping a close eye on wage growth and core inflation, which excludes volatile energy and food prices. Their belief was firm that the surge in prices was merely a temporary blip, not a sign of structural inflation. Yet, the CEOs argued that the higher costs were already being passed on to consumers in some regions like the US, even if not in others like Japan or the Eurozone. They warned that if prices continued to rise, affecting wages and inflation expectations, a policy adjustment might be inevitable. In this clash of perspectives, the question remained, was this inflationary trend temporary or a sign of a structural shift? In the face of this economic puzzle, the task fell to the Federal Reserve to balance the scales. The Federal Reserve, like a vigilant watchman, has been keeping a close eye on two key indicators: wage growth and core inflation. Core inflation, which is a measure of inflation that excludes the volatile prices of energy and food, serves as a more stable indicator of long-term trends. On the other hand, wage growth acts as a harbinger of sustained price rises. A rapid increase in wages can lead to a ripple effect, causing prices to rise and thus sparking inflation. This necessitates quick action from the Federal Reserve to prevent a spiral of rising prices. Moreover, the Federal Reserve stands ready to adjust its policies if necessary. If rising prices begin to significantly affect wages and inflation expectations, the Federal Reserve may need to change its stance. This could involve tightening monetary policy or implementing other measures to curb inflation. But this is no easy task. It's a delicate balancing act, akin to walking a tightrope. On one side, there's the risk of letting inflation run too high, and on the other, there's the danger of stifling economic growth by acting too hastily. The tightrope walk of the Federal Reserve continues as it navigates the intricate dance of inflation control. As the dust settles, the future of inflation in the US remains shrouded in uncertainty. Potential future scenarios for inflation are varied and complex. Economists have observed that the key to controlling inflation lies in achieving a balance between labor supply and demand. This equilibrium could help bring inflation down to the Federal Reserve's target. However, this is not a simple task. The labor market needs to function efficiently, matching employers and workers seamlessly. If not, the country could face the risk of an increased unemployment rate. Additionally, we must consider the role of fiscal policy. Its impact on consumer demand for limited supply goods has been significant, contributing to inflation during the pandemic. How it will continue to affect inflation in the future is yet to be seen. Finally, we must recognize the potential for global commodity price increases and supply chain disruptions to continue driving inflation. These factors, largely out of any one country's control, have been prominent in the recent rise of inflation. In the grand economic theater, the final act of this inflation drama is yet to be played.